Good morning and welcome to the APW Market Wrap for week ending 30th of July 2021. Stuart Williamson here at the helm. So this week we're going to be talking about the UK economy from a residential perspective, property-wise, in the longer term, medium and short, what exactly is going on and what we can expect according to the gurus. Okay, apparently the IMF this week came out with their World Economic Outlook report and they congratulated the UK on expecting the GDP for the country to grow by 7% over the next 12 months. Basically saying it was outperforming the EU in a vaccine-fueled recovery. Now, what does that mean? Basically, they're saying that the UK has now given at least one jab to 69% of the population, a share only surpassed by Canada, who has 71%. The report says in countries with a high vaccination coverage, such as the United Kingdom and Canada, the impact would be mild of further COVID variants. Meanwhile, countries lagging in vaccinations, such as India and Indonesia, would suffer most among the G20 economies. So basically what they're saying is Britain has had a major growth upgrade because of its world-leading vaccination drive, and that's what they expect going forward. So for the economy, fantastic. Medium term, Savills and Oxford Economics have come out with a report this week saying that they don't expect to have a crash, but a soft landing. And what's that based on? Basically they're saying this year they expect the market to grow at 9%, but after that, for it to tail off. And the reason for that occurring would be that they're expecting over the next 5 years, probably about between 21 and 28% growth across the UK, including this year. The key phrase they're using is that affordability limits have become embedded in stress testing of mortgage affordability for borrowers, and caps on lending on high loan to income ratios have been introduced. So basically the regulators have got a strong embedded stress test for all people who want to borrow to make sure they're not borrowing too much. And this is what we had back at the global financial crisis. People were lending way too much and it all got out of control. Hence you had a big crash after that. They're saying now that this stress test has been in place for some time and people aren't as exposed as they were back in 2008, 2009. So they don't expect a crash. They expect a soft landing. But there's 5 parameters that need to be achieved really for that to occur. The pace of economic recovery has to continue, which basically means that the unemployment levels will be contained and employment will go back to pre-pandemic levels. So strong economic recovery. The IMF has said it expects that. So that's number 1. Number 2 is the price growth we've seen over the last 12 months has been driven by a change in buyer profile. Now it's one more weighted to equity-rich home movers buying as opposed to first-time buyers buying. So they have less reliance on mortgage debt. So it's more wealthier people are moving and moving the market forward. That, alongside activity from high earners, means that loan to debt and loan to income ratios have not changed dramatically. So we haven't seen over the last year a huge amount more of debt being taken on, which again we did see at the global financial crisis. As a consequence, buyers active in the market have been able to operate within the bounds of existing mortgage regulation, and this is the stress testing we're talking about. More of these buyers are locking into fixed rates, because there's a lot of fixed rates available out there at the moment. NatWest this week came out with a brand new mortgage, which has some great fixed rates in it over 5 years. Very good. And finally, interest rates are still expected to be gradual and modestly rising, meaning a progressive squeeze on affordability, not a shock. So if you take those aspects, there does not appear to be a trigger for a major house price crash over the next 5 years. And that's what their general view is. So they're saying on the back of that, they expect the Northwest to do 28% between now and 2025, Yorkshire and Humber 28%, Wales 26%, Midlands 24%, East of England 20%. So there's a lot of positivity out there. The only negatives out there at the moment are poor old Aberdeen, which is down by 3%, and London, which has got some losing boroughs in the centre. But that's because it's very much a travel-driven market to a certain extent. So there we have the longer-term approach from IMF, short-term what the Savills Oxford Economics are saying about what they think will happen to the market. And then in the very short term, you can look at the July report for June that's come out from Zoopla. And they're basically saying that current UK house price growth for the year is 5.4%. Demand for homes compared to 2020 is 23% up. And that the supply of new homes available for purchase is actually down by 2% over that period. So what we've got is a shortage of property, a higher demand because of, to a certain extent, the search for space, but also because post Brexit referendum, it's just a release of gas. It's people saying, oh, I've had enough of this. Let's get out and move. Let's make some decisions. And, that's what's occurring. So those are the drivers. Okay. Great reports from the IMF, from Savills, Oxford Economics, and from Zoopla. And if you like that sort of stuff, if you really like your research, you'd like to find out a lot about it, then we're shortly going to be launching our APW Property Partners service, where you can subscribe and get this research sent to you on a weekly basis, as long as a lot of other benefits. So look out for that, APW Property Partners. It'll be here within the next couple of weeks. Overall, then, looking at the market in the UK, very positive. There's very few places that are potentially going to be having negative growth. And we're looking overall about a 22-23% growth over the next 5 years, according to the gurus who know. Thank you very much for this week. Do take care. Cheerio.